Now we will hear from Alexander Aronsohn, a chartered surveyor and current director of technical standards tangible assets at the International Valuation Standards Council. Alexander will discuss the international valuation standards and their importance in building trust in valuation. His presentation will cover the structure of IVS, including general standards and asset standards, and we will hear a bit more about each of these in more detail. So with that, I will hand over to Alexander. Jenny and Marina, please, if you can spotlight Alexander, and the floor is yours. Thank you.
Thank you very much. Hopefully you will all be able to see my presentation. So thank you very much. You've heard a lot about valuation practices, and in a way, I'm going to do the step before. I'm going to tell you about the international valuation standards. So this is the way that we ensure that in whichever country your valuation takes place, they're done to the same quality and the same overarching standards, meaning that you can actually compare like with like. So if you are using, for example, a basis of market value, you will know that the market value in one country is done on exactly the same basis as the market value in another country. So first of all, I'm going to give you a very brief overview of the International Valuation Standards Council, because some of you may not be aware of who we are. So we work with our partners who include other standard setters, regulators, valuation professional organizations, valuation service providers, and the end users of valuation information. In fact, we have over 200 members, most of the VPOs around the world, regulators, the large accounting firms, etc. And the goal of the International Valuation Standards Council is to build trust and confidence in valuation by, one, establishing globally consistent, transparent, high-quality international valuation standards across all assets classes. And that's really what I'm going to speak to you about today. And also supporting the growth of the valuation profession. So in many markets, there may not be an established valuation profession, and we will work with them to help them establish one. And through achieving this, we aim to seek to support business, strengthen financial markets, and most of all, protect the global public interest. So first of all, about the International Valuation Standards, the latest edition of them was published on January 2024, and the effective date is the 31st of January 2025, in order to give our members time to make revisions to their standards, their requirements, and also for translation purposes. And you can see on this slide, not only do we have the International Valuation Standards, but we also have a red line version which shows you the changes from the previous edition, and a basis of conclusion which looks at when we went out for consultation, the responses we received, and the rationale of the technical boards for any changes or not changes made within the standard. And we see this as an extremely important part of a transparent, collaborative standard setting process. Now, in a minute, I'm going to go through the general standards in some detail, and then I'll pause for questions, and then we can go briefly into the asset standards. But this slide really shows you the structure of the standards. So first of all, IVS deals with all aspects of valuation. So we divide it into tangible assets, which includes land, unregistered land, real estate, buildings, collectibles, also infrastructure, mining, etc. And the general standards are on the top line, and they show you everything from your initial instruction to your final report, all the requirements you need to follow. And then underneath, we have the asset standards, which are shown here in blue for the business valuation one, green for the tangible asset ones, and purple for financial instruments. And these provide additional requirements in addition to the general standard. So first of all, looking at our general standards. You can see the structure of the general standards here, and it really follows everything from your initial instruction or your terms of engagement, which you'll see in IVS 101, scope of work, all the way through to your final report, which is contained in IVS 106, documentation and reporting. So the structure of the standard naturally follows the flow that a valuer does. And this was a very important process for us. So when we developed the standard, we wanted to make sure that we followed the process that a valuer follows to develop a value. And it didn't matter whether they were a tangible assets valuer, which many of you will be dealing with in real estate, or a business valuer who may look at the value of the business and the intangible assets, such as the brand. All of them will be following the same process. And the general standards provide requirements that are applicable across all classes of assets and liabilities. The asset standards give you additional requirements for specific assets and liabilities, and the appendices provide additional information and requirements for certain concepts articulated in various chapters. So, for example, you've heard talk today, and obviously not to confuse you, of the three main approaches, the market, cost, and income approach. But remember, underneath those, there are a number of different methods that valuers may use, and those methods are contained within the appendices. So the first chapter is the IVS valuation framework. And, you know, in terms of looking at the valuation framework, there's first of all the principles that a valuer must follow. And these are ethics, competency, compliance, and in addition to professional judgment, there is professional skepticism. The valuer needs to stand back and look and check that that information is actually fit for purpose. We also deal with valuation process quality control. It's extremely important whether you are a sole practitioner as a valuer or whether you work within a large firm, that there is a degree of review and challenge within your valuation. This chapter also deals with the use of specialist or service organizations. The valuer may use external specialists within their valuation. They may use a building surveyor to look at the actual condition of the building and the construction of the buildings. They may use an ESG specialist to look at some of the environmental, social, and governance requirements. But whoever they use, those specialists also have to comply with the requirements of IVS. And it's the valuer's ultimate responsibility that he chooses a specialist or service organization that is fit for purpose of the valuation. Now, I know that many of you are based in different countries, and you may say to me that, well, we have laws within our countries that could vary from IVS. What do we do with these? And IVS very clearly states if legal, statutory, regulatory, or other authoritative requirements appropriate for the purposes and jurisdiction of the valuation conflict with IVS, such requirements should be prioritized, i.e. you have to follow them, explained, documented, and reported in order to remain compliant with IVS. So one of the requirements of producing an IVS compliant valuation is you must follow the laws and regulations of the country in which you're valuing. Now, IVS 101 deals with the scope of work, and we separate between a valuation and a valuation review. A valuation is where you do the actual valuation. A valuation review is where you're reviewing part of the valuation. You're either reviewing a whole valuation for compliance with IVS, in which case we call it a valuation process review, or you are reviewing some of the components of the valuation. Have they used the correct comparables? Are they fit for purpose? In which case, this would be a value review. And within the scope of work, you'll notice that there are requirements from A to O for the valuer to do. So this deals with everything from the asset to the clients to the intended use of the valuer, valuation currency, valuation date, basis of value, nature and extent of the valuer's work and any limitations upon it, the nature and sources of the information upon which the valuer relies, the special assumptions, the specialist, the environmental, social, and governance factors, the type of report, the restrictions on use, and also a statement that the report is compliant with IVS. So one of the very important things to look at when you are giving a valuation instruction is to ensure that the scope of work or terms of engagement are fit for purpose. They are actually what you want to do. And within this section, we say that the client and valuer are required to agree the scope of work for a valuation or a valuation review, that it is appropriate for the intended use. So it's very much a two-way process. So you are saying to the valuer what you want, and the valuer is coming back and saying, well, this is how I think we should approach this within the valuation. Now, IVS 102 deals with the basis of value, and there are a number of different bases of value, and the valuer must select the appropriate basis or bases, because sometimes there's more than one, of value, and follow all applicable requirements associated with that basis or basis of value, whether those requirements are included as part of this standard, so there are IVS defined basis of value, or not, for non-IVS defined basis of value. And I'll explain a bit what I mean by this. So we have IVS defined basis of value, market value, which is used mainly for secured lending or transactional purposes, market rent, equitable value, investment value, synergistic value, which is a form of marriage value. So you could have two assets which have a separate value, such as two flats that make a house, but when they're combined together, the value is greater, and liquidation value. Now, an example of another basis of value is fair value under IFRS, so International Financial Reporting Standards for financial reporting. Now, if you're dealing with fair value under IFRS, though a definition is contained within IVS, the correct place to look at for the standards is the International Financial Reporting Standards, though we're in regular communication with their technical directors, and it's possible to be compliant with both. And you can also have fair value for legal, statutory, and other purposes. There are also premises of value that I won't go into detail today, but they're basic premises of highest and best use, current use and existing use, orderly liquidation, or for sale. Now, one of the questions your colleagues asked me to look at specifically, which I'm sure that Ben and Professor Schuh will go into more detail during the course of these workshops, is the difference between market value and investment value. So market value is the estimated amount for which an asset and or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing, and where the parties have each acted knowledgeably, prudently, and without compulsion. And so it's very much a hypothetical value. You know, you're looking at the concept of a willing buyer and a willing seller, arm's length transaction, and the parties having the same level of information. Investment value varies because you're actually looking at the value of an asset to a particular owner or prospective owner for individual investment or operational objectives. So you might be taking on that owner's data, looking at that data, investigating the data, reviewing it, carrying out your due diligence. So you are looking at two different types of value. Market value is sort of like the hypothetical price of exchange. Investment value, you're looking at that value to that particular owner, and you may be taking on some of their data within it. So looking towards valuation approaches, and you've heard here a very excellent talk going through the approaches in detail. I'm not going to do that. I'm just going to tell you that there is the market, income, and cost approach. And underneath those approaches, there are a number of methods at the valuer's disposal. And IVS 103 requires the valuer to consider and select the most relevant and appropriate valuation approaches for the valuation of the asset or liability based on the attendant's use. Now, though we do not recommend necessarily using more than one method, so for example, if I had a very liquid residential asset where there were a lot of transactions taking place quite frequently and they were all quite similar to each other, I may not go beyond the market approach. But where there is an instance of any form of uncertainty, and without knowing the markets that you all work in, I would think that there could be uncertainty in quite a few of them. I would recommend that more than one approach is used, because it's a way that the valuer can really test the valuation that they do. And though we use market, income and cost approach, and I don't mean to confuse you, to a certain extent, they're all a little bit of a hybrid, because in the income approach, you will be using market information. Where do you get your yields? Where do you get your growth rates? Where do you get your other data? A lot of that will be coming from the market. In the cost approach, when you're looking at costs, a lot of that information will come from the market as well. And one of the things to note, without confusing you, is cost does not necessarily equate to value. I may spend a lot of money on my house putting in gold statues of myself at the cost of 100,000 euros. That would not add 100,000 euros to my place. In fact, it might reduce it by 100,000 euros, because most people would not want gold statues of me within their home. I don't know why, but that seems to be the way that it is. But the point to really notice here is that cost does not always equate to value. And as Ben mentioned, you'd have to take into account depreciation, obsolescence, and other factors. And I wanted to go a little bit into the cost approach here, because I had specific questions from your team in relation to this. So broadly, there are three cost approach methods. There's the replacement cost method, a method that indicates value by calculating the cost of a similar asset, offering an equivalent utility. Ben mentioned the example of a building without sanitation. In this case, the legal requirements now would be to have sanitation. You would probably be looking at a replacement cost method. There's the reproduction cost method, a method under the cost approach that indicates value by calculating the cost to recreating a replica of an asset. I had a situation many years ago when Serbia was moving from its old system towards capitalism, and it was a massive series of industrial buildings that had sort of evolved. No one would build that in the modern day, and therefore when looking at that, very much looking at a reproduction cost method. And then there's the summation method, the method that calculates the value of an asset by the addition of the separate values of its component parts. Now, I don't want to confuse you. I just want to let it know that, look, there are a number of methods underneath this. And when we look at the replacement cost method, a replacement cost is the cost that is relevant to determining the price that a participant would pay, as it is based on replicating the utility of the asset, not the exact physical properties of the asset. And usually the replacement cost is adjusted for physical deterioration and all relevant forms of obsolescence. And after such adjustments, this can be referred to as a depreciated replacement cost. And there's key steps in this method. You should calculate all of the costs that would be incurred by a typical participant seeking to create or obtain an asset providing equivalent utility. You should determine whether there's any depreciation related to physical, functional and external obsolescence associated with the subject asset, and you should deduct total depreciation from the total cost to arrive at a value for the subject asset. And the replacement cost is generally that of a modern equivalent asset, which is one that provides similar function, equivalent utility to the asset being valued, but which is of a current design and constructed or made using current cost-effective materials and data. Now, IVS 104 deals with data and inputs, and it looks at the use of a specialist, of a service organization, the characteristics of relevant data. The data is the macro, it's all that information you consider. The input is the actual information that you put in your valuation, and it also deals with documentation. And when looking at data and inputs, we talk about the characteristics of suitable data. So we have four main characteristics for data, and these characteristics are accurate. The data should be free from error and bias and reflect the characteristics that they are designed to measure. Complete. The set of data is sufficient to address attributes of the assets or liabilities. Timely. The data reflects the market conditions as of the valuation date. And transparent. The source of data can be traced from their origin. Now, I'm aware of in many of the markets that you operate in, because I've operated them myself, there are challenges in relation to data. There are challenges in relation to the transparency and accuracy of data. Well, some data is better than none. You can only use the best data that is available, but the valuer should try and maximize some of these characteristics. And they should also be aware, like I'm aware, that in some countries, there is government data in relation to transactions. However, these transactions are also related to taxation, so they may not be as accurate as you think, and there may be a side deal on the side that deals with the actual purchase price. So you need to look at the data. It's part of the valuer's professional judgment. He should use his professional skepticism, but at the end of the day, some data is better than none. Now, in terms of data, we also have an appendix that deals with environmental, social, and governance factors. And this is very much in a developmental stage. We're quite good on the environmental. We're not necessarily that good on the social and governance. And there is a requirement for the valuer to be aware of relevant legislation and frameworks in relation to environmental, social, and governance factors impacting evaluation. And the impact of significant ESG factors should be considered in determining the value of a company asset or liability. ESG factors can impact valuations both from a qualitative and quantitative perspective and can pose risks or opportunities that should be considered. And ESG factors in the ESG regulatory environment should be considered in valuations to the extent that they are measurable. Not everything is measurable at the moment. There is not all the data, and would be considered reasonable by a valuer applying professional judgment. Now, IVS 105 deals with the selection and use of valuation models to be used in the valuation process. And it also makes the point that no model without the valuer applying professional judgment, for example, an automated valuation model, can produce an IVS compliant valuation. Now, that doesn't mean that it can't be used as a tool within a valuation. We are aware of the development of AI and many other things that are coming into the industry, but at the end of the day, you need the valuer's professional judgment. And as with data, because the two are interconnected, sometimes you look at the data first, put it in the model, find it doesn't work, look back at the data or change the model. There are characteristics as well. And we talk about accuracy, completeness, timeliness, and transparency. And our standards are freely available. So I will be from 31st of January next year, but I am happy to send you any copies if you need them, Ines, for your members to have a look at. Now, IVS 106 deals with documentation and reporting. Now, documentation is always the macro. The valuer will always have more information in their documentation than they will have in their valuation report. And valuation reports and documents are critical and defining features of the international valuation standards, as they collectively insist in creating consistency, professionalism, transparency, comparability, and trust in valuation to serve the public interest. And when we talk about reporting, we have very similar requirements to the scope of work. So it should have the agreed scope of work, the assets being valued, the identity of the valuer, the client, the intended use, the intended users, valuation currency or currencies, valuation date, basis or bases of value, valuation approaches adopted, valuation methods or valuation models, significant sources of selection of significant data and inputs, significant environmental, social, and governance factors considered, any significant or special assumptions, the findings of a specialist or service organization. And what's most important is not only the value, but what you really want to understand is the rationale for the valuation. Why did they choose that approach and not another approach? Why did they look at this data and not that data? All of that should be contained within the valuation report. And it should also have an IVS compliance statement, and it should have the date of the report, which can differ at times from the valuation date. So when you're looking at your valuation reports, make sure, have a look at your scope of work, your terms of engagement, and check that everything they said they'd do, they've done in their valuation report, because the two should very much tally with each other. Now, I'm going to pause here for a second before going to the international valuation standards, asset standards, and I'll be quicker on that, Ines, because I wanted to give the main time to the general standards, but happy to take any questions that you may have at this stage.
So thank you very much, Alexander, for your insights into the IVS and the structure, primarily the overview of the general standards. So people had one key question, and that is if participants can have a copy of the standard. So now that we know they can be freely accessed, I believe via your website, then we can move to the other questions. I have only one in the chat box for now. If market information is required in some way or another for all valuation methods, what are the reliable sources of information for such market information? So well, just one question for now, yeah.
It's one question, but it's a doozy, as we would say. It's quite a difficult one because, to be honest, it varies from market to market. So it depends on which market you're operating in. And it really goes back to what I said. Some data is no better than no data. The valuer can't take the data as face value. They've got to do some form of verification. They've got to understand that information. For example, and it applies to all markets, when I was working in Germany, they had a wonderful government data registry that had the measurements for every single asset. Brilliant news. The only problem was all the measurements were incorrect and they hadn't been done for the past 30 years. So as a valuer, I had to look at that data, but I also had to do my own measurements and say, based on the government data, this is the breakdown. Based on the actual measurements, this is the breakdown. The value wouldn't change. The way I analyze that value would change. So there is, your valuer should be aware of the market and in which they operate. Not all markets are as developed as each other, but they should use the data that is available. They should use their professional judgment and their professional skepticism when reviewing that data. And in some cases, with definitely specialist assets, so if we're talking about electricity plants or water production, there may be so few assets that I may be looking at other markets and making comparables and adjustments to them. So I hope that answers that question. I'm happy to take any more questions. Clarity on the standards, they're only freely available on our website from the 31st of January. So to avoid that issue, Ines, I will send you a copy that you can share with everyone. And we have no issue in relation to that. So I will send you after this presentation an email. So if there's no questions, I can see that you're being a lot kinder on me than you were with the other two presenters. So thank you very much for that. And I will now move towards the asset standards. Now, these, I'm not going to go into detail on them, but I wanted to then open up to further conversation. But you can see the asset standards, the ones from IVS 200 to 230 deal with business valuation. The ones from 300 to 410 deal with tangible assets, or what you might know as real estate valuation. and IVS 500 deals with financial instruments. So in terms of the business valuation, we have the chapter on the valuation of business and business interests. We have intangible assets, which is brands. So for example, valuing a hotel and valuing a Hilton hotel may give you very different values. In fact, arguably, if you take the top 50 businesses in the world, about 80% of their value is around intangible assets and their value of their brand. IVS 220 deals with non-financial liabilities, and IVS 230 deals with inventory. I'd like to pause here a little bit to just have a look at the tangible asset standards, because these are very important. First of all, not only do they deal with registered land, but in the work that we did with UN Habitat, they also deal with unregistered land, tribal land, informal land, all of which, communal land, all of which have to be valued by the valuer. IVS 300 gives you further information in relation to the valuation of not only plant and equipment, but also infrastructure. IVS 400 deals with real property interest. That includes land and agriculture, and IVS 410 deals with development property. And we've made sure that the standards align with the general standards, but also there's additional information. So when we talk about comparables within IVS 400, you will see reference to a hierarchy of comparables, from direct comparable evidence to indirect comparable evidence. And you can go further. Ben, as technical director of, as the valuation director of the Royal Institution of Chartered Surveyors, they also have guidance notes that they will issue that will give you further detail in terms of looking at comparables and the quality of comparables and the sort of hierarchy. And IVS 410 deals with very much development property. IVS 500 deals with financial instruments. I won't go into detail on them at the moment, but if you are in that field, this is where you would look at in relation to that. Now, as part of a transparent standard setting process, we also have an agenda consultation. And our agenda consultation, we come out every 3 years. And within it, we've got a number of key topics that are shown here. You can see our key topics: environmental, social and governance, technology and valuation risk. You can also see some of the current topics that we're planning to look at in the next 0 to 2 years. For example, investigations and evidence dealing with inspection, private v public markets, trophy assets. And we also have some topics that we're looking at in the next 2 to 3 years, one of which is a topic that I know that you're dealing with, which is eminent domain valuation. So we will be looking to do a perspective paper, which is sort of a precursor to standard setting, looking at the issue of eminent domain valuation. One of the difficulties that we've got is, though most eminent domain valuations will start off with market value, there is specific requirements on country to country basis on how they work out compensation. Not all markets work it out in the same way, and part of the valuer's skill is understanding those requirements and understanding how to look at it. So I've given you a very brief summary. As Ben is no doubt aware, I could make this presentation last for hours, but what I'd really like to do is to open up to all of your questions. So I'm going to stop sharing now. Please feel free to ask me any questions in relation to our standards, and I will be very happy to answer them. Thank you.
Thank you so much, Alexander, for this very comprehensive presentation. So I don't have anything in the chat box. People are either very shy or a bit overwhelmed by the amount of information. But actually, if I may, go ahead.
No, I was going to suggest that Ben might be able to ask, because he will know some of the questions that people might be a bit shy to ask. But please go ahead, Ines.
Sure. I was actually just going to open the floor with a question that, you know, is dear to my heart. maybe to you, Alexander, or, to the other speakers. So maybe if you could share an instance of a project where evaluation did not go as planned, what was learned, how were these insights applied in future projects? Did it, lead to any policy changes, either in your standards or in a country's policy, or in another standard that you work closely with? So maybe just a practical insight.
Okay, so that's a bit of $1 million question. I'm going to give you a very general answer, and then I'm going to quickly shift it to Ben. But I would say no valuation goes as planned. And it sort of relates to Ben's opening comment about being a bit of a Sherlock Holmes in valuation. It is a process of discovery. Every asset is different. Every market is different. You are really relying on the professional judgment and skill of the valuer. And what we're really trying to do is harmonize things within markets. And I would say that all markets have their pros and cons. Some of the most difficult that I worked with was I was actually in Serbia valuing what the factory for tobacco that was eventually bought by Philip Morris at a time when they had no market. They were moving from socialism to capitalism, and there was no transparency of information. And in those situations, you're more reliant on things like the cost approach, because that's your starting point of how to do it. But there's challenges in every market. I would say our challenge at the moment is AI. So though we've recently published this edition of the International Valuation Standards, we already have to begin to think about the next edition. And artificial intelligence is developing at quite a fast rate. It's at the moment, we see it as a tool that can be used by the valuer. In future standards, I think we'll need more transparency. If you are using your AI, you should be saying how you use it in your scope of work and what you're using it on. You should state it within your valuation report. You should also look at client confidentiality and data challenges that you may have in relation to that. ESG is another massive challenge for us. It's developing all the time. We've got a lot of good data on E, less on S and G. And the other bit is it's developing at different rates in different countries. Some countries are focusing on net zero carbon buildings. Other countries are focusing on getting their infrastructure in place, and actually having water and electricity for everyone. Valuation risk is another key topic, how we manage the valuation risk. But what I'm going to do is do a quick side shift to Ben here to see if he wants to add any more on difficult markets and the Sherlock Holmes perspective.
Thanks, Alex. Yeah, and the questions are starting to roll in now as well, I can see. But really, going back to that sort of challenge, and it's that, what's gone wrong is very often actually in the terms of reference, the instructions which are given. And I'm thinking particularly if there's a valuation which has been done for the project, and then an individual is not happy with the compensation that they are being offered, that they may go and get their own valuation, and sometimes the challenge is actually those instructions aren't the same to the valuer, and that's where the international standards really come into being very, very valuable to being able to understand the process that the valuer has been through. So rather than arguing about whether it should be $500,000 or $75,000, you're actually looking at the element that has caused that difference. So that I've applied a yield of 10 and Alex has applied a yield of 8. Well, why we should be able to explain why we've applied those different yields, and therefore we can focus in those differences to being able to put a rationale around. So we stop arguing about the difference in numbers, but we start to talk about the difference in why those numbers have a variance. And the process that the international valuation standards require that storytelling that we talked about last week, of being able to follow each chapter of the valuation becomes really very, very valuable. So making sure that those terms of reference, and if there's a great discrepancy in the number, the first place I'd look is in the terms of reference and hold them up alongside each other and say, well, was the valuer actually asked the same question or not? So that's one of the, sort of, has the valuer been asked what the property market value is, or have they been asked to tell the client what it's worth to them? So an investment valuation or a market valuation, and they would give different answers. So being able to work through those is really important.
Great. Great discussion. So I think now the questions are coming in, and maybe I'll start with this one because it's the broadest one. And this is actually from AIIB. For ESG, the E is clear. Please clarify more about the S and G in valuation. So I think this will maybe respond to some of the other questions. So people are asking, about the integration of free prior informed consent, stakeholder engagement, considering, indigenous peoples and other, vulnerable groups. So maybe a bit of an overview on that, please, to start with.
Okay, so I'm actually going to quote you directly from the standards because that's the easiest way to do it. We do give examples of social and governance factors. So if we start off with social factors, they include, but they're not limited to, the following: community relations, conflict, customer satisfaction, data protection and privacy, development of human capital, i.e. the health and the education, employee engagement, gender equality and racial equality, good health and well-being, human rights, working conditions, working environment. Now, some of these are quite difficult to quantify, as you can see. That's why I said we're still in a data gathering exercise. If I look at examples of governance factors, once again, these could include, but not limited to, audit committee structure, board diversity and structure, bribery and corruption, corporate governance, donations, ESG reporting standards and regulatory costs, executive remuneration, institutional strength, management succession planning, partnerships, political lobbying, rule of law, transparency, whistleblower schemes. So these are just examples. There's many other factors. We're also discussing that you could have a very green building, but what happens if a non-green tenant comes in it? How does that affect it? So these are very much in developmental stage. We are reviewing and looking at these, and we are in a data gathering exercise. And the environmental, from a tangible asset side, is probably Ben and my bread and butter. I mean, to be honest, we've been doing it for 20 years. But the one thing that I would say is don't be scared. ESG is just data. Valuers have always used data, and it's just looking at the correct data, gathering that data. But in many of these, we won't have that information. It's a data gathering exercise. But hopefully the value in those markets would have the professional judgments. And it really goes back to what I said, that you should only consider ESG as much as another valuer would in their valuation. I'm going to jump to Ben because he looks very studious with all those books behind him. It's like he swallowed a library. But Ben, would you add any more to that? Because I know the S and the G we're struggling with as well, and we're working through it slowly.
Yeah, I think the only thing I'd add, Alex, is, and that was great to see how relevant the standards are to reel off those elements that are included in the standards for consideration. It is really helpful. But I think it's also very important that we stress that it's not the valuer's job to make policy. The valuers, and again we touched on this last week, it's about the valuer receiving instructions. They can help with the policy, but to do the valuation they need to have the instruction. So there was a question earlier on today in the chat about nomadic tribes and how to compensate nomadic tribes. So that would fall into perhaps some of the social element that we talked about previously. but the valuer shouldn't be making the decision about whether a nomadic tribe should receive compensation or not. That's a policy process. If you should be asking the valuer is how much should the nomadic tribe be paid in compensation for losing pasture fields which they only use once every 2 years or something, whatever the rotation policy, that's a valuers. They can start to address those challenges, but they shouldn't be making up the policy of whether the tribe or the nomadic tribe have the right to do that process. That's within the legislation of the country, and sort of being able to have that clarity around there. And the only other one I wanted to just point out was, again, it goes back to the data point, Alex. Very often in these projects, there's quite a lot of data which is actually captured very early on in the process. There are surveys done, there are inventories created. I think it would be really helpful if valuers were involved at that very early stage, so that there's an understanding about the data and information which is going to be collected, not necessarily by the valuer, but by the project in a wider sense, and how much of that data and information will be accessible by the valuer, and whether they can rely on it. So again, getting that capture of data and information, and then being able to use it for more than one purpose, starts to make a lot of economic sense in project management procedures. So I'll be quiet there as well. So
great, Ben, helpful. Alex, very helpful. Before I move on to reading out a few of the other questions, because you mentioned nomadic tribes, and someone asked about indigenous peoples and their considerations. A question for you is, could you share some peculiarities or something specific on valuation of indigenous peoples' lands from your experience?
Yeah, again, we made some really great progress a couple of years ago, didn't we, Alex, when the international valuation standards tended to read as if they were designed and only for use in urban mature economies. And we recognized that was a real challenge, and we made some fairly minor adjustments to the language within the standards, which opened it up to being applicable to formal land, informal land settlements, and recognition that people will hold rights to use land in different formats. And that was really quite a big step, because it gave the legitimacy of the international valuation standards to a much wider audience of individuals and valuers. So that was a really big step and a big change at that point. But again, those rights, again, there's quite a difficult decisions that need to be made, which change from when you are occupying land illegally to having rights to use, but they're not formally recorded. And those aren't necessarily, well, they're not the same thing. And having that clarity about sort of, again, just using a very simple approach, doesn't feel right to compensate somebody for an illegal use. And when you say so, perhaps processing drugs or something within a factory, it doesn't seem right, even though they might be making a lot of money out of that absolutely illegal use.
Understood. Perfect.
And just adding to Ben,
I
just want to share with you this manual. Hopefully you can see it on screen. On the valuation of unregistered land. This actually gives you more detail in relation to that. We will be able to share that manual with you outside of this call. So you can see a copy of the manual here that will give you more details on the valuation of unregistered land.
Great. And Alexandra, I think this one is for you. So someone is asking, about how, IVSC works with the various, stakeholders or interested parties. So the specific question is IVSC approached by governments with help for government-led expropriation, either at the implementation stage, dispute resolution, or capacity building?
We work in conjunction with all our members and stakeholders. Some of them at government level do approach us, and we are involved in some government projects, some at quasi-government level. Also, very much with our member organisations, such as Ben from the Royal Institution of Chartered Surveyors. They will also be dealing with that very much at that level. We have boards, a standards review board, and we have technical boards, business valuation, financial instruments board, and tangible assets board, and they are made up of our members as well, some of them who could be from government type institutions. So we work with all stakeholders across all markets. It would normally be that they would come and approach us as the international valuation standards, and we're very much also work to build valuation professional organizations in a number of markets, because some markets are less developed, maybe still working on an old broker model and don't have valuation professionals as such. So hopefully that helps.
Okay, great. And a question, actually two questions, but one essential meaning of the questions is, someone is talking about the challenge with government-led expropriation and, providing justification to the government for using valuation methods that are different from, national methods that may be in place, especially given that lenders, MDBs don't finance land acquisition. So the government finances it, but the lender then may, put in some requirements. So how do you marry these two? And is there a difference between, government-led expropriation and private market transactions? So how do these all, play into factor together?
So they'd all start off, I would say, with market value. Most government things will work on market value, but then they will have their own specific formulas in relation to it. Do they always tally? No. In some countries, there may be some form of additional compensation that they give for inconvenience. There's also issues in relation to blight. So you might know that a government is looking to buy land 10 years before it actually happens. The argument would be that is already beginning to be affected before the transaction. Most in compensation exclude blight. I know they do in the UK. So there would be a date from which the compensation is calculated. But it very much varies from market to market. Most will use market value as the basis, and then we'll have some very specific formulas in relation to how that is to be adjusted or calculated in relation to compensation. I'm going to go to Ben to see if he wants to add a little bit more, because that's quite a fun question. So
yeah, indeed, there's some good questions come from this audience. They are certainly keep you on your toes, and I think it also ties into one of the other questions in this that just came through about financial instruments.
Absolutely.
Got my brain thinking, well, actually, a lot of these projects are financial instruments at the end of the day. They're very physical. You think of them in roads or dams and things, but actually they do move into that financial instrument area. And some of the things, again, around audit process, financial reporting requirements start to kick in because they become into that financial instrument. So again, understanding how the overall project is funded and what will happen to it at the appropriate points of the project management, again, are quite challenging. And looking at that transfer from being a loan to complete the project to then being owned by the country is quite an interesting area to consider. But moving back to the valuation of the individual asset, again, the policies of the development banks who are providing the loans are that the affected people need to have their livelihood reinstated. and as we discussed last week, that's not the case in most national policies. So there's a substantial difference in that, and that really needs to be cleared and approved at the loan initiation stage, so that the governments can fund that additional payment. And Zara might want to jump in and correct me here or put me right, but the process of where that actual extra payment comes from, does it come from the government, or is it just built into the loan that the development bank are going to? It shouldn't actually impact the valuation, but it does impact the policies that need to be implemented at the very early stages.
Yeah, so while we wait for Zara to come back on, I think absolutely, yes, it's basically an agreement between the government and the MDB on, what methods should be applied, whatever, but the ultimate is, as you said, full replacement and reinstatement. So full replacement cost and full reinstatement of livelihoods. Zara, please, I leave it to you to discuss in more detail on how AIIB and other MDBs work in practice.
Just to add to what Ben said, I think in the question there was another element also about the private sector operations when the lender is a private company and there is a government land acquisition. And the question was if lender doesn't have impact on the government land acquisition. And this is also, this strategically is approached differently during project preparation. And usually there are different multi-sided discussions and negotiations on how that approach to compensation, including approach to valuation, have to be handled. And sometimes private companies are, based on the audit results, are adjusting the differences between whatever is envisaged by government land acquisition and what projects have to top up to meet the requirements of replacement cost and restatement of the properties and livelihoods. And I will open floor also for others to contribute if need be. And there are a lot of interesting questions in the chat, including on valuation on agricultural lands. Should it be comparable method or cost method? Quite an interesting and tricky question.
I can start with that. I read that myself, Suruhi, and I was going to answer that and then maybe go to the financial instruments. So first of all, the approach that you use depends very much on the data that is available. So it is not possible for Ben or myself to give you a prescriptive answer saying you should use this method or that method. If there are a lot of land transactions taking place, then you would probably be using a market approach and a comparable method. But then the other bit is, and this is one where I'm going to throw a stone in the water and Ben will probably shoot me down, there's also the principle of highest and best use. So I might be looking at agricultural land, but it is if it's legally, physically, and financially possible to turn that agricultural land into, let's say, a residential or an industrial development under the principle of highest and best use of market value, as strange as it might seem, I might be valuing that agricultural land as actually a building. And to do that, I would probably be using a residual method. So where you go to the gross development value, you take off all the costs and you end up with a valuation of the land. So it really depends on the case as to what approach you use and what you're actually allowed to do. I remember when I was once in one country, it was in the Middle East, and they said, can you value land? And I said, yes. And I said, what land do you want me to value? And they said, the whole country. And I didn't mean to be mean, but I laughed because it very much depends on the planning permission and what you're able to do with the land to a certain extent that makes the value of it. In terms of financial instruments, just moving quickly to the side side. We do have a section on financial instruments. They follow the same general standards that we follow. I would argue that they have an increasing use of data and models when you're valuing financial instruments. I would argue that there is a very severe degree of review and challenge that is required. And when I share IVS review, we're quite extensive on that. It is a specialism. We do have a particular board that looks at it, and financial instruments covers a raft of things. But what's important to us is it doesn't matter whether you're valuing it as a tangible asset, as a business, as a financial instrument. A lot of things go through this stage. You should be using the same bases, the same standards and the same principles when you're valuing them, and you should have the same level of rigor when you're doing it. So I hope that picks off two of the questions that you've received. Sorry to throw highest and best use into the equation, Ben. That'll be a fun one for you at another time. Don't know if you want to add any more.
Oh, indeed. I mean, that's. I'm a pretty simple guy, as you know, Alex. And I always see. I mean, the point is that what could the individuals do with their land? What if they decided to sell tomorrow morning? What? And I'll use the word price, and going back to the very beginning of this presentation, price, value, and worth. Price, value, and cost. What price could they get for it? And if you're thinking that we're trying to be fair to people in this process, both people's and the taxpayer, then it's not unreasonable to be able to start with a compensation amount, the value that they could get from the marketplace. What would somebody pay them tomorrow morning for it? You then have to decide whether they were a special purchaser or whether they were the market where you've got more than one purchaser. You then need to look at the documentation which surrounds the land. Is it registered? If it's not registered, that doesn't mean to say it's got no value. It just probably means that actually there's greater security, so it's less risky. And all those elements start to play into this calculation of what the market would pay for it. And I think you need to just keep reminding ourselves that when we're talking about land and real estate, it's the economic characteristics of those types of assets which are different. In other words, it's location. You can't move it. No two properties are the same. They might be very similar, but they're not the same because they're not on the same piece of land. So, and all those things start to have either very small impacts on the value, either increasing or decreasing, or very big impacts on land values, and close to transportation systems, close to markets, fisheries near rivers. What is it that creates that economic entrepreneurial process which drives market value?
Okay, good. Thank you. So there are some questions coming up. We do have about 15 minutes in this session, so maybe I can take one or two more questions and then do a wrap up. And as a reminder, again, that any question that is not responded to today, we will try and pick them up next Monday. So an interesting one, do international standards mandatorily require valuer to do a due diligence on government valuation processes or methods? And another one quickly to be responded, with now natural capital values coming up, how do we reconcile the natural capital with the social capital? So again, a bit of a play on the Ines aspects of valuation.
Okay, so once again, they're very interesting questions. Let's deal with the natural capital one first and the social value. So this is an area that's still being explored. We did issue a perspective paper looking at social value. So there may be a value to society, for instance, in having a museum and an additional value that comes from it, or other sorts of buildings. That is something that we're still looking at. In terms of natural capital value, I know that that's something that the RICS under the Roland Group, led by James Kavanagh, has been looking at. Funnily enough, I know that it's something that also being looked at by the International Public Sector Accounting Standards Board. So this is very much something that we're still trying to work out ourselves and look at the methodology of, and look at the natural capital value in relation to that. So that's still developing. In terms of governments, it's not our job to criticize any governments as a valuation standard setter, though we may have our personal opinion in a lot of markets. We have to deal with the actual laws that are applicable in the jurisdiction in which we're undertaking our valuation. And that's a very important factor of compliance. Does that mean that separately we may have side chats with governments when they approach us? Then yes, we're very happy to do that. We're very happy to discuss ways that things can be better. But these are, as Ben goes back, it's very much policy decision. I wish we had enough power as your attendees thought we did. It would be quite nice to be active in government policy decisions, but we just look at valuation. But for example, there's a policy coming around that Ben knows about a lot, prudential value, which is an implementation of Basel III law. And I would say that a lot of VPOs are quite involved in discussing with certain departments how they can make that happen. So there are aspects where we would be able to advise on policy, but it would be very much where we're approached. It's not really that much the other way around, to be honest with you. Ben, over to you.
Yeah, I think the only thing I'd add, Alex, is that from this audience point of view, it's really important to note that in the international valuation standards, there are requirements around expertise of the valuer, and you need to know and understand your local market. And this is one of the challenges about bringing in international valuers to come and work in on a particular project. They need also the support of local valuers to make sure that these nuances are understood. So it's very difficult to just apply a blanket process to these. It's a matter of understanding. But the question about whether the valuer's got a responsibility to do some due diligence, yes, they have. They've got a responsibility to do some due diligence to provide a valuation which is in accordance with the law of that particular country. If they can't do it, they need to get the knowledge and experience to be able to deliver that from another source. But Zara, again, you've got your hand up to comment on that part.
Yeah, if I may just come, and I will welcome also other colleagues to join me, maybe to share other views or to contribute. So this is the second day we are discussing that there could be policy level issues related to compensation and valuation related issues. Now, valuation is about the methods and approaches, how the market value or unit rate is calculated. But the way on how we approach what is the eligibility, how we approach compensation for each specific asset, this is more of policy level issue. Like Ben pointed out, the impact on nomadic people when they are using land, how to compensate that. Or if we are trying to understand market value of the land used by indigenous people, what are the criteria we have to use to evaluate as a comparables? Should we consider other comparable lands that are close to forest or close to river to ensure that those people would be able to buy similar land, which will provide them similar types of benefits? Going back to the policy, all MDBs had the policies which are also referred in the loan agreements. And being referred in the loan agreements, those become an umbrella, the principles that have to be followed under the project. And most of our participants are our representatives and specialists from implementing agencies. you all use resettlement plans and resettlement frameworks, and there is a chapter on comparison between the policy of the MFI, which will finance the project, and also the governmental regulations for different types of items. Usually it is who is eligible for compensation, or what are the requirements for information disclosure, or what are the requirements for public consultations. Now, valuation is part of those comparable indicators that you have to look at if there are differences between the principles of replacement cost and the definition, which has 5 elements. One of each is market value, and also regulations under the government. So this have to be analyzed when you are developing a framework or resettlement plan under your project. And based on the analysis of that comparison, there is usually a third column which says how to bridge the gap. So this is the opportunity to make a decision and to see how that gaps should be bridged. It should be additional allowances. There could be some top-ups in different countries, in different contexts. It is approached differently. But just to re-emphasize that there are tools in involuntary settlement when these are financed by MFIs, such as framework and settlement plans and loan agreements, which gives that legal ground to move forward with solutions. Thank you.
Thank you, Zara, so much for that. And yes, please, if colleagues from AIIB or NDB want to, provide a final thought, yes, please, Gorshin, go ahead.
Yes, thanks, Zara, for your comments. And I actually am thinking for member countries of NDBs, they actually have done a lot of international projects. And in those projects, they involved land acquisition and resettlement, and also actually need to implement the policy of the bank. But the problem is they actually, in order to push the project forward, they just to try to convince the bank how the standard implemented actually meet the international standard and meet the replacement cost. So I think the discussion we have the day before and today are very good, and the practice are very good. I think we actually need to do some more detail or more specific work for the NDBs in the projects to demonstrate the process we actually are doing, advocating. So I think we do need some demonstration projects in our resettlement process to demonstrate local government, because the local government actually are very tough in this process. In many countries, they actually let the process of land valuation, and they also have existing regulations and policies to do that work. So you are trying to do the things in accordance with your system, but they have existing system and they are more powerful. So we need to compromise or to demonstrate then what you are talking about, you are advocating, are really valuable to them, and they can learn from you. Then this is a process of collaboration, and then this is also the value added the bank can provide to the member country, I think. Thanks.
Thank you, Zara. Over to you.
I completely agree that we need to do more to demonstrate, to have showcase projects that would demonstrate the benefits for both beneficiaries, affected people, and for government on different levels, so to different stakeholders. Just to add to the point on regulations under the different governments, if we would look at the evolution of regulations on eminent domain, on valuation in most of our member countries, we will see that they are changing and progressing. Markets are developing, and states are adapting to different developments of the markets. So we also have to be flexible enough in terms of approaches and methodologies, having in mind the principle of replacement cost. but regulations in the countries we operate are changing. At the moment, for example, in one of the countries, and hopefully when we will finish, it will become one of the showcases. After changes of legislation, the methodology that was applied before doesn't work. There are now legal regulations based on the market, but there is no practice of valuation based on comparable methods and market methods. So we also have to adapt and to help the borrowers to keep up with their legal development of their legal regulations, and to provide that capacity support to develop respective methods and to be able to do involuntary settlement in line with the policies. Yeah, just to note that governments in our countries, the legislation is also quite fast in terms of development, adjusting to the market realities. Thank you.